U.S. Federal Reserve kept its key interest rate on hold, a decision that was widely expected. But in this current climate of uncertainty, what can we expect going forward? Sam Chai of TD Asset Management is here with some insights. Sam, great to talk to you on this. As we said, not a surprise that they stayed on hold, but there's a lot going on beneath that headline. What's your takeaway?
So as you just mentioned, Greg, the Fed has kept the policy rate unchanged in this meeting. And another key takeaway here is that the Fed has slowed the quantitative tightening program for U.S. Treasury products as well. And one of the key things, or one of the many key things that market participants are watching coming to the Fed meeting is the update to the economic projections. So overall, as expected, it has went to a more stagflationary direction. So, in a broad stroke, core PCE, the Fed's favorite inflation metric, has been revised up for this year. Unemployment rate for this year has also been revised up, whereas for GDP growth rate has been revised down this year, and also slightly for the next 2 years as well. So we're all quite a stagflationary, impulse from where they're seeing things. One other key metrics is obviously the dot plot as well. So that has been kept unchanged. We are still seeing 2 cuts this year from the Fed, followed by 2 additional cuts in 2026 as well. So that has been the same as in the prior SCP forecast.
That's how they see it. You start hearing words like stagflation. This is not a phrase that people like to hear. In response to that decision, the market itself, what's their expectation of the path going forward? Because now you got risks on both sides, don't you?
For sure. And that's making Fed's job quite challenging. I think to think about that question, we can first think about what's the expectation coming into this meeting. So recall that since January, inflation data in the U.S. has come in hotter than expected. So CPI on average has been upside surprises. Inflation expectations, at least for some surveys, has been actually skyrocketing. So inflation has been hot. On the labor market front, unemployment rate has actually stayed unchanged year to date. So labor market is solid. And we also know from Chair Powell himself that he has reiterated quite a few times that policy is well positioned and that they're in no hurry to adjust policy stance. So coming to this meeting, market expected a hold, not just this meeting, but for the May meeting as well, and possibly for the first cut in June or July, followed by one additional cut. And post the announcement and post the updated economic projections, we see that interest rate has slightly declined, partially because that the quantitative tightening paring back is sort of a dovish surprise. In addition, risk assets has reacted well to this because there was this fear that the Fed may have to react a bit hawkish, but that hasn't really materialized. And so going forward, the market has priced in a full cut by July this year, followed by 1 additional cut in second half, and then 2 additional cuts next year. So bring the terminal rate to roughly around 3.5%.
When I think about the environment we're living through right now, global trade tensions, uncertainty around on-again, off-again tariffs, this has got to complicate the monetary policy picture for the Fed.
For sure. And we mentioned this word stagflation, right? And that is a very challenging environment for the Fed, particularly because a stagflationary environment push both of their mandates further from their targets. And I think one thing we have to realize is that despite the Fed basically penciling down the similar number of cuts this year and next year versus 3 months ago, there are 2 types of cuts. The first type is good cuts, right? So good news cut means that, okay, so labor market is solid. We're seeing a bit more deflationary progress in the economy. And so they can just naturally dial back the restrictiveness of the rate. But there's another type of cut too, which is that inflation is still a risk, but we need to cut because labor market has been deteriorating really quickly, or financial condition has tightened a lot, like equity markets having a big correction, possibly, for instance, on escalating trade conflict. And it does seem like increasing the case, and as per their more stagflationary forecast, that the path to that good type of cut is narrowing, whereas the odd of a short cut is steadily on the rise.
You talked about what the Fed had in their projections, what the market is now thinking post this announcement. What are your thoughts about rates going forward?
In the short term, we think that rates could be range bound. So Chair Powell himself mentioned that like policy rate today continue to be well positioned, and there's no hurry to adjust policy stance. And my expectation is that absent of a meaningful labor market deterioration, the Federal Reserve can be patient, watch for more data under this very elevated high policy uncertainty environment, and wait for more disinflationary progress, and possibly deliver another cut in June or later this year. That being said, we cannot rule out the possibility that the Fed will maybe even cut in the next meeting. But that is contingent on labor market deteriorating really quickly, or we are seeing a much bigger correction in the equity market. And there's a pretty high bar to that.
You mentioned the correction in the equity markets, a lot of volatility in financial markets. Part of that story is the possibility, at least the specter of a recession in the U.S. What are your thoughts on that front?
So definitely being talked a bit more nowadays. And I think, admittedly, the odds of recession has increased. If we watch like a few key indicators, for one, equity market has corrected 8%, SP 500 from 12 to today. So it has been a good leading indicator for the economy, economic activities. Consumer sentiment has deteriorated meaningfully as well among many surveys. And finally, if you look at the Atlanta GDP nowcast model, for Q1, it's showing negative 1.8%. Well, that's the worst since 2022. So the stagflationary impulse does seem to be weighing on growth. However, our base case is still that a soft landing seems to be still the more likely case here. For one, when you look at the equity market corrections, while it's meaningful, 10%, like historically, a 10% correction typically is recorrected over time, and a 60% rebound is still likely. And when you look at labor market data, when we watch quite a few leading indicators, including initial jobless claims, there's no particular red light that's flashing right now to us. And finally, on the micro level, corporate fundamentals remain solid, corporate balance sheet remain quite healthy, and so overall, we see that the risk to a recessionary scenario to still be more of a risk scenario instead of a base scenario for us.